Welcome back to Community Real Estate Talk Show. I'm your host, Tyler Freed. We've had an opportunity to speak to some great people today, and I'm really excited for our next guest, Matthew Gardner. He chairs the Board of Trustees at the Washington Center for Real Estate Research at the University of Washington. The man knows everything about economics, and I'm very excited to have you, so let's bring him on. Matthew, you there?
I am. Good morning or good afternoon.
How are you?
I am well. How are you?
Doing great. Glad to have you on. Take it away.
Thank you for inviting me.
You're very welcome. So we're excited to hear what's happening out there. What are you seeing?
I think as far as the housing market is concerned, we're in what I believe is going to be a prolonged period of recovery. Prices are on their way up, which is good, although I think we'll see price growth that's going to slow in 2014 compared to last year. I'd like to see more houses on the market for sale. I think you're probably hearing a lot about that already. But in general, the market's looking pretty solid. But I think there are still some headwinds out there which concern me a little bit that are probably going to cause, I wouldn't say price contraction, but the fact that we'll start seeing slower price growth. The biggest ones of those are obviously lack of inventory, as I just mentioned. But additionally, we expect to see interest rates continue to rise. And because of that, we're probably going to see mid-single-digit price growth for houses in 2014.
Which is still healthy.
Oh, absolutely, yeah. I mean, I don't like markets which go up by double digits, by 10+%. Those are clearly unsustainable. So when we start seeing growth in that inflation plus a couple of percent, which I think we expect to see certainly in the Puget Sound, and it'll probably be higher than that in King County. The reason for that is that people actually are prepared to pay more to live close to where they work. But in general, the market, I think, is going to be sustainable, even though interest rates are surely going to continue to rise next year. Although I don't expect to see a huge jump, I would not be surprised to see the average 30-year fixed rate somewhere in the low to mid-fives by this time next year.
So the growth the greater Seattle area incurred, do you feel that's been healthy, or has that got a little out of whack?
Well, the thing is, it's interesting. There's certainly a price recovery in place, but price growth is really not predictable. We saw a big drop, obviously, in 2008 onwards, a recovery then because of various tax incentives, which overly stimulated the market. We then contracted a little bit. But the growth going forward, is it positive? Yes, it is. But I think ultimately a reasonable rate of appreciation, I think everyone would expect to see and everyone likes to see. Is it too much? No. I mean, the recovery came off a point whereby you could actually buy houses for less than it cost to build them, which is i.e. less than replacement cost. When we see a recovery from that point, it's going to be fairly dramatic as people say, yes, we believe in the market again. So it jumps up fairly quickly. Going forward, however, I don't see that continuing, and therefore we're going to see growth, but a slower rate of growth.
Have you been keeping an eye on kind of what's going on in the San Francisco, Southern California market and their exponential growth? I mean, is that scary down there? I mean,
yes,
I know they had a lot.
I mean, if you look back at it from a historic perspective, the Bay Area used to be the least affordable housing market in the country, which has basically meant that I believe at the worst point, 6% of the population could afford to buy a house, which was quite amazing. The growth you've seen there, yes, it's been very frenetic, and a lot of that has been driven by not only a belief in the market, but the fact that the levels of inventory were so low down there. And a lot of that was actually caused by the banks. Banks were not releasing homes on the market for sale, which they owned. They were ostensibly holding inventory back to see prices go up. We'll probably see that starting to occur less in this year, so I can't expect we'll see the kind of price growth we saw in the Bay Area continuing through next year. But it's certainly one of the markets which has bounced back quite amazingly.
Let's go back to the foreclosures and I know we talked about shadow inventory years and years ago, and we didn't really see it, and kind of the banks were just letting the market appreciate, not really flood it with properties that might take it down. Is that the case?
I think that's slowing down. I mean, obviously, a lot of people at one point were really of the belief that there was going to be a veritable tsunami wave of foreclosed houses coming on the market. It was going to flood the market with inventory. That was going to cause prices to contract. Clearly, we have not seen that. That has not been the case. Ultimately, I think we have to work through this inventory, certainly. You can't just have banks owning houses which are empty, or having houses where people are still living in them but not paying the mortgage. They need to, as time goes on, they've been fixing those issues. Foreclosures have been working their way through the pipeline a little bit better. And as such, it's been a gradual inflection of those homes in the market. Certainly in the metro area in Seattle, the percentage of homes sold over the last 3 or 4 months has gone up, which were distressed in one way, shape, or form. We need to get these through the system. It's important that we do that, and that's happening. But we're not going to see a flood of foreclosed homes coming onto the market. I would be very, very surprised to see that.
So you think they'll continue the trend of just kind of slowly releasing like they did last year?
Pretty much so, yes. I think it's getting better. Plus the fact the numbers, the actual inventory numbers, is very difficult to figure out unless you are a bank yourself, how many there are really out there. A lot of people come up with some amazing numbers, but the disparity I've seen has been in the millions across the U.S. So people are basically guessing as to how many there are. But I think as we go forward, I would not be surprised to see that a general release of that inventory in the market. I certainly do not expect it to flood the market through this year or even beyond. The number of new foreclosure filings is actually continuing to slow.
Now let's go local.
Yeah.
What are your thoughts with what's happening in the market in the greater Puget Sound area, the Seattle, and are you seeing any trends that you're aware of right now that are jumping out to you, particular hot areas?
Well, actually, it's less hot areas. It's been interesting to see some of the contractions. What we saw, and it's actually we tend to look at listing price as much as we look at sales price. And if you take King County, for example, at least in the single-family home market, we've really seen a contraction of the average listing price, which started back in last March. So I think what actually happened was the market got a bit ahead of itself. We've seen a gradual appreciation of sale prices, which is good, but the list prices have come down. Now, what we saw back in the spring and early summer was the spread between list and sale prices was huge, was far bigger than it normally is. And because of that, buyers are starting to become more cognizant of the market and more wary of the market and not willing to jump into anything, regardless of price. And certainly, we found a point a year or so ago, maybe a bit longer, whereby the problem with sales were the appraisals were just not coming in. Because of that, we've seen a slow contraction of average list price. And so it's the relationship between average list and average sale price is about where it needs to be. So we're actually in a pretty good shape. So I think the expectations of sellers, which was very high, has relaxed somewhat, but the market has pretty much taken it in its stride. Geographically also, as I mentioned earlier, King County is a market which is one which people certainly, if they can afford to live in, they wish to. Why? Well, obviously, King County has the largest number of businesses. It's where most people work. And there is a willingness and a desire to live, relatively speaking, close to where you work. Because of that, prices obviously are far higher in King County than they are pretty much anywhere else other than maybe San Juan County. But San Juan's obviously is an anomaly up there on the islands.
Matthew, I know you... Oh, go ahead.
Sorry?
I know you keep a pulse on the employment coming in. Is it increasing, or what are you seeing in terms of...
Oh, it's growing. Our models are currently forecasting in the metro area we'll probably see just shy of 40,000 new jobs created in 2014. So that's an employment growth rate a bit less than we saw in 2013, but it's still in the high 2% range. That is obviously a very positive factor, and certainly when it comes when we look at housing and housing growth and housing demand. Most recently, obviously, my company's been keeping very close tabs, or we were keeping close tabs on the Boeing Corporation. Thankfully, their decision to stay is, a very positive one, specifically for Snohomish County, to a lesser extent down in King County. But overall growth patterns are actually very positive. So we looked at probably something like 40,000 jobs or so, mid-30s maybe, for the course of 2014. That, in turn, is going to help with demand for housing. If there is a concern, and we always talk about a lot of ifs when we talk about real estate economics or economics in general, it's the fact of the lack of first-time buyers in the marketplace. We're actually looking at some national numbers. It's quite amazing if you look at the percentage of people aged between 25 and 34 who are still living with their parents at home. It's the highest point we've seen in decades.
Wow.
So we're over 16%. Now, these people in this age cohort, they are prime first-time buyers. They're having a problem. Several problems, actually, when it comes to buying a house. One is their uncertainty still over the housing market, if it makes sense. They're ultimately now very mobile. They don't want to get tied to a house. They will tend to move their jobs more frequently. But more importantly than that, it's their ability to get down payments and their quality of credit. So I think that is a niche market which has not recovered yet, and it's going to be very important that does recover. And I think it will, but it's going to take probably another year or so before it starts happening.
So the savings for the down payment, how do they work on
historically, what do these people do? A lot of times they called up mum and dad and asked for help with the down payments.
Right. And we're not seeing that as much?
Mum and dad did that. How do they do it? For the better part, a lot of them put that debt on their home equity lines of credit. Well, they're not doing that anymore. And as such, getting that down payment requirements obviously have risen dramatically. They have since the housing meltdown. So as those are very high, that's an issue. Additionally, banks and the average FICO scores on approved loans is still very, very high. So I think we need to see banks being certainly not going back to the world of 2004, 5, 6, where basically anyone could get a mortgage. It was very inappropriate. That will not come back. But the requirements are still very high, and that is a stumbling block still for a lot of first-time buyers.
Excellent, Matthew. Well, I really appreciate you coming in and talking on the show and just giving us an expert opinion on what's going on out there.
You're welcome. Happy to come on and talk about it.
Excellent. Well, enjoy the rest of the weekend, and we'll have you back on soon.
I look forward to it.
Thanks, Matthew. Take care.
All right, Tyler. Bye-bye.
Bye. And that wraps up the show here. Thank you for tuning in to Clay 1180 AM and Community Real Estate Talk Show. We'll be back 1 o'clock next Saturday. Thank you.